Hey all, welcome to ShareTreck. This is Raj here. Friends, today I'm going to talk about 4 different concepts. The first one is going to be 3 possibilities that could happen. It's a progressive elaboration of the theme that I had spoken about what is likely to happen to the market with tariffs and other things. The second part of it is going to be basically about how passive investing in index funds could probably have created an inefficiency in market pricing and how it could probably impact us at a later date. It's one of those aspects. The third one I'm talking about is the importance of institutions and reputation of the market in order to be able to capture all the investors' attention and trust, and how a lack of that in emerging markets prevents many investors from taking a risk in investing in an emerging market, and why that is very important for us to keep an eye on at this point of time. With that said, let's get started. Welcome back, friends. The market's behavior is often unpredictable, and once a major move happens, analysts and commentators rush to rationalize it. In my view, high deficits make it difficult to sustain low bond yields for long, especially as we wait new policies from the incoming administrations. And the reason I'm talking about this once again, after having made 3 videos so far, is because today the bond yields dropped after the mere appointment of a Treasury Secretary. But I believe this is an overreaction or a temporary reaction. Currently, Trump is not in charge, but is potentially in charge, and his presidency is characterized by an opportunistic transactional approach rather than a fixed ideology. This makes the market predictions challenging, as decisions can change abruptly based on short-term needs, transactional needs, or who has the ear of the president. And under this kind of a scenario, it's going to be very volatile, because look at the possible economic scenarios under the new administration. Based on my understanding of economics, here are some potential scenarios and their outcomes. Very quickly, tariffs plus tax cut as promised, likely to lead to inflation and conflict with the Fed as Fed raises interest rates. The Fed's action of raising the interest rate may not contain the inflation due to the policy-driven nature of the inflation. Next, tariffs plus tax cuts plus 2 trillion spending cuts. This is likely to be a bit expense neutral, but painful for citizens with high unemployment and inflation. As the federal employees are let go, it's not just going to be 18,000 employees or 45,000 employees let off from some department or the other. Those employees have a basket of consumption which employs other people, like they may cut their gym membership, they may cut their Netflix subscription, they may reduce consumption of certain commodities or foods or whatever. So all those people are going to get affected. Maybe they don't buy the coffee from the coffee shop anymore. So those things may happen, and there will be ancillary. It's like a chain reaction. It's like dominoes. The Fed may struggle to address inflation effectively because the tariffs would be creating inflation despite the fact that unemployment is going up. And again, Fed is constrained because of the policy-driven nature, and at this stage, maybe there will be a clash between the Fed and the president, and president may want to have direct control over setting interest rates. So he may want to control both monetary policy as well as fiscal policy, which is a no-no. But it could possibly happen because Trump has always had what he wanted and the Congress has given to him. So that's a possibility as well, which cannot be ruled out. The third possibility is status quo. Let us say Trump comes in and then he tweets something, he points to a shiny object, goes on a few tours, does a bit of golfing and whatnot. A lot of sound bites. 4 years go by, nothing happened. That would be very good, because there would be a soft landing, as long as Fed retains freedom to manage rates. And the Fed is not going to face any major challenges unless there are some geopolitical risks or a pandemic or something that comes in and disturbs the apple cart. And the only early risk that may emerge is when the Congress will have to consider the tax cuts. Because in economics, we have a saying, ceteris paribus, which means everything else being constant, if you do something, something else will happen. So everything else being constant, if Trump doesn't do anything, it's going to be very good for the markets. Because first of all, you're going to lose the FTC. There'll be a new FTC who may not be that aggressive. Then you're going to have the competition authorities and others diluted, regulations diluted. It's going to be super. But the risk that's going to emerge is that everything else being constant is not going to be valid, because tax cuts have to be handled by the Congress. It's going to expire. They have to renew it, or they have to let it expire. So whatever they do out there, if they don't renew it, then you're going to have immediate problems. But if they renew it, then our deficit is going to go up, and that's going to have an impact on the yields of the bond, which will in turn affect the stock market. So that's the way I'm looking at it. Now, next topic I want to talk with you is the passive investing and market inefficiencies that it is creating. There seems to be a growing concern that passive investing in index funds may be distorting the market. Unlike active investing, where a fund manager actively assesses the value of individual stocks, and in a thematic manner, they select and cherry pick stocks, buy it at a particular time, sell it at a particular time in order to generate returns for the investor. Historically, this kind of active investing has not given predictable, consistent results. As a result, we came up with the idea that passive investing, allocating funds systematically to all investment components, would be a very good idea. So there are ETFs which are based on index, and there are index mutual funds. They just replicate the components of the index by buying same shares in the same ratio, and they hold it. They don't trade very often. They only trade when the index changes its components. They also make the respective change. That's all they do. So, and management fees are also less. So it has become very popular. So there are many people who do systematic investment plans. It's called as SIP. And they would be putting $500 per month, let us say, into a particular index ETF. And that 500 goes in like clockwork every month at the same time. And there are many, many people who are doing those kind of investments. What it does is that instead of an asset manager picking up individual stocks based on their value, performance, future prospects, it goes directly to support this particular index. And therefore, the index may have, let us say, stocks like MagFi, which do extremely well. And then there'll be a bunch of stocks which are good, but not as good as MagFi. And then you have the average stock, which are lackluster. And then you have the really poor performing ones, which are waiting to be kicked out of the index. So all of those have the same status. So there is no discrimination between them because they are all index components. So that could be creating some inefficiencies. And we are still trying to find out how it may affect the market and how it will affect the retail investor. So that's the other concept that I was coming across, which I'm digging into. And for retail investors like us, this means that the market's apparent strength may not reflect underlying fundamentals. And now I would like to come to the third component. Like, this is where I'm talking about credibility of institutions and the value of reputation and trust in the field of finance. Swiss banks are trusted because they have proved time and again that they have a reputation for secrecy, they have a reputation for privacy and all those things. And that's why people put their millions into Swiss banks. So once the Swiss bank starts betraying all those expectations, they won't stand the same value. Now let's talk about the United States. While members of Congress investing in millions face fewer restrictions compared to corporate insiders, this raises ethical questions about transparency and fairness in the market. People like me, when I used to work for the bank had very clear policies. They would tell us which are the blackout periods when we can't buy or sell the stock. And we could only buy or sell the stock at other times. And if we were in a project that was sensitive, then we were not allowed to trade in the company's stock. So that's what we had, but there is no such rules for the Congress. So basically, if a congressman gets information as part of their work and they take a financial decision to buy or sell a stock, they're not doing anything illegal, because that's not illegal. And there are many congresspersons who have billions and millions of dollars of investments, and they're making good money. In fact, there is an ETF called NANC, and I think it follows Nancy Pelosi's portfolio, and it's doing pretty well. So that's one aspect I just wanted to point out. And it's very important because we need transparency and fairness in the market. And some would consider that there is a lack of fairness and there's a lack of transparency in the market from that quarter. Trust in institutions and market stability, investor confidence in the US stock market is built on transparency. Next, let's talk about trust in institutions and market stability. Investor confidence in US stock market was built on transparency, strong institutions, and very reliable regulations and prompt enforcement of those regulations. That's what made US market what it is, and that's why people from all over the world come to invest in the US market, and companies from all over the world have ADRs, which are traded in the American Stock Exchange. Any erosions of these principles, such as exceptions, one-off deals, or non-prosecution of cases, could deter international investors. Historically, emerging markets suffer from unreliable compliance and governance, and the US could face similar risks if these foundational pillars weaken. Watching how the next administration governs will be very critical. Now you'll say, Raj, what is it? Why are you talking about the US like this? Well, if you have seen the stock of Tesla stock gained 40%. Okay. Now there has been no change in Tesla business as such. The only change is that Elon Musk bankrolled Trump's campaign, and he's got a driver's seat out there with the new administration. And the expectation probably is that he's going to get some favorable regulations, and he's going to get some favorable deregulations, which can help Tesla be a better company and do much better. So that's the implicit message with that premium. But nothing has happened as yet. Once the new administration comes in and once things start playing out, we'll have to see whether the premium was actually deserved or the premium was a false expectation. So we'll have to see how it all works out, so that US continues to maintain its position as the topmost stock market, the most trusted and reliable capital market in the world. So that's very important for the markets. Next, I want to give you some clarification on genomic investments. I want to address some misconceptions about my stance on genomic investments. One of the viewers questioned my credibility because I have made many CRISPR videos without consistently holding the stock. So let me explain once again. In one of my earlier videos, I had explained why we should look at AI. In fact, I have been doing that for quite a while now, saying that why we should look more at AI and how AI will converge with genomics and robotics at a later date. And it's going to be 3 revolutions in one, and high productivity is going to be very good for all of us. I even spoke about universal basic income being needed in order to give purchasing power to the people. So coming back to the clarification, I have held CRISPR at times and I have sold at other times. I exited CRISPR with a lot of profits. Right now, I still have Altimmune, I still have Illumina in my portfolio, and probably one more genomic company, I don't remember. My decision making has evolved after learning from my experience with Tesla. I sold Tesla a couple of months ago at a loss because I disapproved of Elon Musk's behavior, and I thought that he got 55 billion. For that, the company should have got his undivided attention as a CEO. Instead of him having his finger on multiple pies and into Twitter with a lot of tweets and also playing games, video games, and being a leading person in that. So in fact, it was a decision that I made more emotionally than a business perspective. I booked the loss, and now Tesla has gone up a lot, and I'm saying, I lost a good opportunity. I only realized that I had prioritized personal biases over technical or fundamental analysis or actual news. I believe in the future of genomics and its potential to produce multiple blue chip companies. However, my lesson is that we cannot be dogmatic. We have to look at the technicals and we have to look at the fundamentals when we are investing. As a retiree, my risk tolerance differs from that of young investors. While young investors may benefit from dollar cost averaging into companies like CRISPR, Beam Therapeutics, Editas Medicine, or Caribou Biosciences, you name it, they can do it now as the prices go down. But I avoid situations where I cannot discern confidently whether I am catching a falling knife or I am doing a successful dollar cost averaging. It's very difficult, my friends, to realize whether we are catching a falling knife or we are successfully dollar cost averaging. We know only as an after fact, afterwards, because we don't know how much more the stocks are going to fall. So this is all a this is all a question of risk profile. And I've also made it always clear in many of the videos. I would say, listen, I am talking from the point of view as a conservative retired investor. But for young people, you should be able to take risks. I've always mentioned that diversification and risk management, regardless of your enthusiasm for genomics, it's very important. Even if you decide that your portfolio is going to be entirely genomics, which of course I will highly disapprove of, because that's not true diversification. But even if you decided to do that, let us say you're absolutely ideological and you say genomics is all I want. So I would request that if you do that, your portfolio should not be overexposed to a single company. You should diversify among genomics sector with multiple companies. So the diversification could be that you need to have something in the equipment manufacturers who do the sequencing machines. You need to have something with the companies that create cell therapies as a contract manufacturer. You need to have some with the companies which are actually doing cutting edge research to come up with new therapies. So you have to look at all those aspects and then diversify so that you got at least some amount of risk protection. Otherwise, it's going to be difficult. And if you don't want to do all that, you just want to be in genomics, you could have a genomics ETF like ARC-G, for example, as a part of your portfolio instead of being 100% of your portfolio, even though it gives you exposure to a whole lot of genomic companies. So that's my 2 cents, my friends. With your allocations in genomics spread across multiple companies, it will give you some amount of risk management, but it's still not good enough in my opinion, from my vantage point. I share these thoughts with you not as an expert, but as an investor navigating the same challenges like you. I don't think I have learned all the lessons as an investor despite 3 decades in the market as a retail investor, because there is always more to learn. I appreciate your feedback. I appreciate your criticism and ideas. Please keep them coming. I'm not being defensive out here. I love it. It makes me a better investor, because since starting this channel, I have become a much better investor. I'm doing fewer trades, and the fewer trades that I'm doing are really good trades, and there are a lot of green in my portfolio. So I have learned a lot. And I also learn from your feedback and comments, because some of you definitely share your strategies and comments, and I think about them and I overlay them with my own concepts. And if I'm convinced, for example, I bought Altimmune, which is a company that one of our subscribers was talking about. I checked it out. I liked the case, and I've already booked profit on half of my holdings of Altimmune. The other half is still in a bit of a red, but I'm pretty confident that it's going to yield results. So I do those kind of things, and my goal is to provide clarity, not to mislead. And I have no interest where you are investing, what you're investing, because I'm not selling anything. I'm not being sponsored by any company or investment company. I do not sell investment advice. So there is no ulterior motive for me to mislead you. I just want to follow the market while keeping a close eye on genomics. And I wanted to make that very, very clear. So that's why I made that comment in my previous video, which kind of was misunderstood. I think, I'll state once again, I think genomics is a field too important to ignore. It's going to be the future of medicine. And I think AI is going to get miniaturized, more strong, more powerful. I think battery technologies are going to improve significantly. And I think robotics is going to be able to move without a cable because of improved battery technology. And then there's going to be a convergence of robotics, genomics, and AI. And that's going to be 3 industrial revolutions fused into one. I'm also doing a review of a book called as Life 3.0, Life in the Time, Being Human in the Time of AI. I put that in a separate channel. So what that book talks about is the possibilities that could happen with AI. And one of the possibilities which I found very interesting is that slowly and steadily, just like in the cell phone, we add an extra SIM and we add extra storage, it's going to be possible for us to have implants. And there could be a time when maybe our consciousness can migrate into a machine and we could take the multi-light year journey needed to go to a distant planet and colonize. So all of those possibilities are there in the future if you were to game out the future possibilities. So that book is very interesting. I've been spending a lot of time looking at it. So if you are interested, you can go to the other channel. I will put a link in the end screen. You can go and check out 2 of the videos I made. So there is life 1.0, life 2.0, and life 3.0. There are different types. Life 1.0, for example, is bacteria, which cannot improve itself, which is just dictated by the genetics that it has got. So there is a lot of things to unpack out there. So I would digress. I want to keep this video short, so I'm going to end the video out here. And thanks once again for being engaged, guys. Help me grow the channel. Ask your friends to join, and also give me a feedback in the comment section. What is it that you want to see in the channel? If you want a specific company or something to be covered, please put it in here, and I will try to do that as soon as I get an opportunity. Thanks and have a great day. Bye for now.